Backtracking, how to use historical charts to help you find trading patterns. Now, in the not too distant past, technical analysts, or as we call them, chartists, that's how we see ourselves, used to have to use a pen or a pencil and paper and draw out stock charts in search for patterns, looking for roadmaps from the past to help them find trends worth trading in the future. Now, some stocks and ETFs leave such clues, others do not. We are looking for the former and forget about the latter. Throughout the course of all the trainings, whenever I say stocks, you can also read into that ETFs or exchange traded funds. So what we're looking for is we are looking for stocks and ETFs that leave patterns that allow us to look at what they've done in the past and help us see what they may very well do in the future. Now, there has to be enough movement of the stock or ETF to make it worth buying. If it is a utility stock that over the course of a year might move 75 cents, forget about it. It's not worth going after. We also want to pay close attention to the volatility. We want something that moves, and again, if it moves too erratically, if it's too volatile and you can't track it, then of course it's not worth looking at. One quick thing to always look at before you spend much time on any stock or ETF is immediately check out what the bid and ask is. That's the price to buy, the price to sell. Always remember when you're looking at bid and ask, you wonder, what do I pay to buy it? It's always going to be the higher price. You're always going to sell it for the lower price. And again, the bid and ask should only be a few pennies apart, not dollars apart. If they're dollars apart, it means it is not traded very often. Stay away from it because you have to make up the spread. The minute you buy something, it has to move up at least as much to cover the cost of selling it than what you paid for it. Remember, you're going to pay more, it's going to be worth less. You want that distance between what you pay for it and what you can immediately sell it for to be as small as possible. Why? Because if you have to dump it, you don't want to immediately jump into something and find out it's illiquid and you're losing dollars a share if things don't go your way. And again, that lack of spread shows you that it is traded a great deal and it is quite volatile enough for you to potentially consider. Then, of course, you're going to look at the stock chart. And as we look at the stock chart that is on the screen, it's a chart of SPY, the S&P 500 Trust Series exchange traded fund that we track every single day at chartingwealth.com. And when we look at the Bollinger Bands, they are the blue dashes on the top half of our screen. And in the middle is where the stock price typically is. We can see candles, our Heikin Ashi candlesticks, in the shaded area. Sometimes they do push outside the Bollinger Bands, but they always come in. One thing that we look for too to track volatility is look at how far apart the Bollinger Bands are. If it's simply straight across the page and the Bollinger Bands are tight and they never move back and forth, you don't have a lot of volatility there. There's not going to be a lot to trade. So we want to pay close attention to them. Now, when we start looking at a stock or an ETF and we are trying to determine whether it's backtrackable, how do you like that word? What we want to look for after we've identified that it's something that moves, it's something that has volatility, we then want to see whether or not it's something that's actually trackable. And what you want to look for are weekly vertical crossovers to begin with. Are there weekly vertical crossovers and are they haphazard or do they make sense? Is there enough between the time that the blue line crosses over the red, either going up or down, that you can actually get into a trade? That is there a couple of weeks, 4 or 5 weeks, or many weeks? The bigger and the longer the weeks, the higher number of weeks there are, the bigger the move, the better. means when you're jumping into something, you've got lots of time to watch it rack up all sorts of virtual dollars in your practice trade. Is it something you can see on the chart? Now remember, the weekly vertical crossover, if you're not familiar with what that is, you need to do a lot more studying at our channel. It is when the weekly price percent oscillator crosses over the red signal line. It's the number one signal we have for a potential trade. And does it make sense? Does the chart allow you to use it? All of our charts allow us to use the weekly vertical crossover again and again and again. And it's beautiful. We can see it happening again and again and again, giving us opportunities. As we look at, and gold is another one, just beautiful. So when you're looking at something to determine if it's something that you can backtrack and find trades in the past, it gives you some indication as to whether or not you might be able to do trades in the future. That's what's so important about going back in time and being able to do it. Instead of 30, 40, 50 years ago where you had to pull out your pen and a piece of paper, you had to draw your own candlesticks and figure all of this out and do calculations. Now, these internet-based charting platforms like freestockcharts.com, and the paid version we have TC2000. You'll see a link in the show notes to get a discount on that when you want to get serious about it and get TC2000. It's what we've used for years and love. It also is one of the few that has the price percent oscillator, which is what we use on over. It's our main indicator. We also have the derivative oscillator on there. And then we use some exponential moving averages. We have the Bollinger Bands. We have the Heiken Ashi candlesticks. So again, we want to go back in time and find charts where you have clear distinctions and clear signs of weekly vertical crossovers. When you have those on your chart, and when those occur and the stock or ETFs move in the direction of that crossover, whether it's going down or up, and you might say, why do I care if something's going down? Well, it tells you first that it's a potential sell sign, and then if it does have an inverse to it or has an option on it, like a put, we look at something like the S&P 500, it actually has an inverse to the S&P 500. You know what that is? SH. It is actually the ProShares short of the S&P 500, and it moves in the opposite direction. As the S&P is going up, SH is going down. As the S&P is going down, guess what? SH is going up. It's quite pretty. It gives you some more options when the market is actually tanking. Also, options. We've got some great options training at the channel that you can take, a 3-part series. Again, want you to go to the website, sign up. Just put in your name, email address, and you'll receive our daily reviews and the daily trainings that we do every day. And in those, we do pitch in quite occasionally the 3-part series on options, so you can learn more about that. But for right now, just look for clean weekly vertical crossovers. We do have something also on our 2-day chart called a recross. That is where the 2-day chart moves in the opposite direction of the weekly, then crosses back over, which gives you an opportunity at times to jump into a trade also. So we go and we look for those opportunities as well. We talk about these things on the channel every day. Every day we have a daily market review, once a week, our weekly market review, and we teach what it is we are seeing there on the stock charts, on the 4 ETFs that we cover, the S&P 500, the NASDAQ 100, 20-year bonds, and gold. It gives you a nice breadth of markets, a commodity, gold, a bond, 20-year government bonds in the U.S., and of course the S&P 500 and the NASDAQ 100 is depicted by QQQ. So again, these are highly liquid, these are chartable, these are ETFs where you do see weekly vertical crossovers and 2-day recrosses. We want you to learn these things with us. We want you to learn to backtrack. And as you're looking, Maybe it's your favorite stock or an ETF that you like. Perhaps it's a business sector that you are in. That's what you work in on a daily basis. You might want to see if that's trackable. And the way you do it is you go to these charts, you put it in, you look at the bid ask, make sure that that it's tight. The number between the bid and the ask is not more than a few pennies. That indeed it is something that has some volatility, that it does move dollars, not just pennies, over a reasonable amount of time, and also that you have weekly vertical crossovers, that when those crossovers occur, it moves in that direction for a couple of weeks or more, standardly. Doesn't have to do it every time, but most times. And of course, you want to then start tracking it, practice trading it as often as is possible. You will learn the emotions, you'll learn the personality, you'll start learning how well it works actually if you're practice trading it. And you'll see in your show notes every day that we send out with our daily reviews and our once a week weekly review and forecast, you will see in there daily market worksheets, weekly market worksheets, and the all-important trade worksheet, which you fill out every time you do a practice trade. I want you to practice with us every single day. We want you to be with us. 10 to 15 minutes is all we ask, and you will get a knack for this. You don't need to spend hours. In fact, too much time will warp your mind, and you won't be getting anything. In fact, you'll burn out very quickly. So pace yourself. This is a long-term race. You're going to do this if you want to be successful at it for decades, okay? You're going to learn how to do this. You're going to practice, practice, practice until you get really good at successfully doing practice trades. Then and only then might you consider ever using real money, combining what we teach you here, the books you read, and your other experiences, because this has to work for you in your lifestyle with the time you have to devote to it. But who can't devote 10 to 15 minutes a day every day the market's open to learn how this really works? It's worth every minute of time you spend if you spend it wisely. We always love to hear from you. CW@chartingwealth.com. Our book, Charting Your Way to Wealth, is available. You'll see links in the show notes to all these things. We love to hear from you. CW@chartingwealth.com. God bless. All the best from the whole team at Charting Wealth World Headquarters.